Hi, hello everyone. It is natural that for any shares or for that matter any securities that are traded in the financial markets, they are bound to change. There are no stable or fixed financial markets. Stable markets, if found, do not achieve the purpose of the traders or for that matter for any companies or investments, nor it adds to the growth of the economy, nor attract investments. So many traders are wondering why there is a change in the share prices from one day to another, or for that matter from one moment to another. These questions are followed by analysis and interpretations that may be objective and true, but they may also followed by imagination, which may be far from reality, making it a breeding ground for rumors, which may negatively affect the investment decisions. This in turn may expose investors in the financial market to heavy losses. Therefore, we must know and understand the answer to the important question, why share prices fluctuate in the financial markets. Let's discuss this in today's video. You can only buy low and sell high if you know why and when the stock prices will move up and down. This is an old adage even the non-investors are well aware of. This is the simplest explanation we can give on how people make money in the stock markets. But it does not explain why the high and lows happen. Accordingly, there is no one specific reason why there is a fluctuation in the share prices. It is difficult to measure and explain all the reasons because of so much of overlapping elements that happen in the market. Sometimes unexpected news or developments happen which may theoretically increase the share prices. In the same way, sometimes any news developments or any negativity comes into the market which will decline the share prices. As such, a lot depends upon information. Information may come in many forms, such as annual reports, quarterly reports, press releases, news, stories, court cases, tweets, social media, and general market information. Investors, whether consciously or not, incorporate all these new informations into the impressions of their stock. Every investor reacts to this information differently, and their reaction may range widely from lack of interest to panic or to joy. Depending upon their reactions, the investors may decide to buy, hold the shares for some time, or even to sell. Now, ups and downs in the share market clearly makes it difficult and challenging. In general, it depends upon the supply and demand. When the supply is less and the demand is more of the shares, that particular share goes up. And when the supply and demand is more or less equal, the price is more or less stable with a very little sort of a variation. And when the supply is more and the demand is less for the shares, it drops or the share prices decline to fall. In short, share prices change because of the demand and supply. Think of the share market as a big auction, a market where there are a lot of bidders who wants to sell and buy the shares. Now, for example, take the case of Tata Motors in National Stock Exchange. Nearly 6 million volume of shares are traded in a single day, which translates to about 12,500 share volume trade per minute. That's how the volume of transactions that happens for a single share in a day in any stock market. Understanding supply and demand is very easy, but what is difficult is to comprehend what people think about a particular share and why people like a particular stock and dislike another stock. This comes down to figuring out what news is positive and what news is negative for the company. There are many answers to this question, and if you ask any investor, they have their own ideas and strategies. That being said, the principal theory is that the price movement of the shares indicates what the investor thinks the value of a company is. Now let us see the reasons for the fluctuation of these apart from the demand and supply. What are the reasons for the change in share prices? This can be broadly classified into major three factors and other secondary factors. These factors may not impact, all the factors may not impact But there are some factors which are theoretical and practically important, and others have a secondary effect. These are, first is the economic factors, second is the factors that is directly related to the company, third is the factors that is related to the investors and stock traders in the market, and lastly there are the other secondary factors. Let us see first the economic factors. Now, naturally the financial markets are directly affected by the economic factors and the general economic situation. If the economy is stable and enjoys a high rate of GDP, less unemployment, high income per capita, it leads to high performance of all the companies. If not for all the companies, for majority of the companies, which leads to higher performance by the companies and also leads to high activity in the financial market. Various strategists in the financial sector analyzes these economic indicators currently along with the future projections of these economic indicators. Some of the economic indicators that affect the price movement of the shares for the investors can be, first is the interest rate. Interest rates have a significant impact in the financial markets. If banks offer high interest rates, the one that has been done in the late 70s and 80s when the interest rates were more than 10%, normally people will prefer to put their money in banking sector rather than financial markets because of the guaranteed return of income. In contrast, high rates of interest offered to companies by the banks will lead to increase in cost of investment, thereby reduced profits, which will have a negative impact on the company's performance and also on the payment of dividends. Thus, it will reduce or may reduce the demand for shares for these companies, eventually resulting in decline in the share prices. In case of lower interest rate, the demand for funds will be more, and then the subsequent demand for shares will increase, thereby increasing the share prices. On the other hand, high interest rates lowers the demand for funds, and then the demand for shares is lower. When the bank rate is low, it gives customers more funds with low interest rates. A low interest rate induces the customers to borrow more funds and put money on speculation for these securities. This results in the rise of the price of securities that are actively traded. When the bank rate is high, the banks cannot give or avail greater credit limits to the customers. As a result, less money will be borrowed from the bank for speculative purposes. This results in the fall of price of securities. Now, secondly, inflation also affects the price movements. Inflation is nothing but general increase in the overall level of prices. Price level is the weighted average price of all goods and services in the economy. Simple example, 20 years ago, X amount had a purchasing value of goods and services much more than what is the purchasing power for the same goods and services as of today, because of inflation and gradual loss of worth compared to its present value. The increase in inflation and the prices in the value of goods and services decreases the appetite of the customers to buy these products, especially non-essential ones, which leads to decline in the profitability of the companies and thus lower profits. This in turn may dampen the enthusiasm of the investors to invest or buy shares in the financial markets, resulting in decline in the share prices. Now, if you see the economy as a whole, fluctuations in the economy also results in changes in the share prices, mainly referred to as the booms and depression. Under favorable conditions, that is during the boom time, the share prices goes up, and the share prices decline during depression and during recession times. Share prices gradually rise during recovery and declines during recession. Lastly, the political climate also plays a major role. Political factors that range from relations with the neighboring countries, or for that matter any other country, to government policies can affect the share prices. Political changes also cause share price fluctuations. The stock market is very, very sensitive to political changes. An outbreak of war will force the share prices to fall. The announcement of certain taxes in the budget by the finance minister, or for that matter any other budget proposal, may result in either increase or decrease in the share prices. Now, let us look at the other factors which is related directly to the company which affects the share prices. The company and its shares are the center of the investment decisions. In general, the good performance of a company in a natural environment attracts investment and increases the share price because the demand for the shares is increased. Likewise, if the performance of the company is poor, the demand will be less, resulting in decline in the share prices, depending upon the circumstances and the data for each company. Thus, the issue here is entirely about the company and its performance. The mature investor does not normally invest in companies which are weak because it does not achieve his objective of investing or acquiring good assets or gaining profits through dividends. Now, to further clarify these changes in the share price of a company also depends on several other factors. Firstly, it depends upon the company's strength, its efficiency, capability, quality of products and services, professionalism, reputation, along with other factors related to confidence. Secondly, the most important thing for the company is its earnings. Earnings are the profit that the company makes. And in the long run, no company can survive if it does not make profits. If a company does not make profits, then it will not last for a long time. Public companies are required to report their earnings yearly and also in each and every quarter. The market watches these figures with great attention, and these are reflected in the share prices. The reason behind is that the various analysts base their future value of a company based upon these earnings projections, earning base such as earning per share, and valuation multiples such as the PE ratio. If a company's results are much better than expected, then the share prices increases. And if the performance of the company is much lower than what is expected, then the share prices falls down. Periodic and non-periodic information and data published by the companies are directly related to the rise in share prices. If the news is good, share prices will go up, and if the news are negative, the share prices will decline. The company's news materiality also reflects on the share prices. An imperative example of the news is mergers and acquisitions, launching of new products, new contracts, change in management, layoffs, financial and non-financial scandals, etc. These all affect the price movements of a particular stock. The other factor is the company's history and the outlook. A good history of the company is one of the reasons for a good future. Historical information and charts can be used to predict share patterns and share price changes. Historical prices are a very useful way of predicting future prices. If traders can familiarize these patterns, they can recognize the patterns if they occur again. However, this is not the case always with companies who change their products frequently. For example, products produced by the company specialized in mobile phones compared with the company which are into dairy and the juice products. Now, the other thing is the number of shares, shareholders, tradable shares, and acquisition also plays an important role in the demand and supply of the shares. On the other hand, if there is an increase in supply of shares by insider of the company, that also creates confidence among others, thinking that there is a value for the company in the future, which also leads to increase in demand for the shares, thereby increasing the price of the shares. Opinions, again, expressed by financial analysts on the company's performance, affects the company's share price significantly. if analysts felt that the fair value of the company is much more than what is the traded value of a particular share, then the demand for these shares will go up depending upon the recommendation given by these analysts, thereby increasing the share prices. On the other hand, the recommendation, if negative, will make the share prices decline because of the increase in supply, which results in sell-off and drop in share prices. Usually, the share price is also affected due to corporate actions taken. For example, the share prices falls down if the company decides to issue bonus shares. When the company issues bonus shares, there are more shares in the market, but overall the share prices goes down. The share prices also goes down when the company increases capital by using the principle of priority based on subscription rights. Here again, the number of shares goes up, but the share prices are reduced. The share prices are also negatively affected due to corruption, lawsuits and sanctions against the company, or defamation by regulators. This will cause a decline in the value of share prices in the financial markets. Now, lastly, the share prices may also be affected because of the developments that happen in the sector in which the company operates. Dividends also indicate the movement in share prices. When companies make announcements of dividends, it is likely that the share prices will go up or down. It is important to note that if the dividend declared is more than what is expected, the share prices goes up. And if the dividend declared is less than what is expected by the investors, the share prices is generally seen to decline. Now let us look at the factor relating to the traders and investors which influences the share prices. The behavior of the stock traders and investors in the market trading transactions has a significant impact on the share prices, particularly because of the lack of awareness and knowledge among some traders in the market. Some of the aspects and behaviors can be looked into as rumors, emotions and personal qualities, speculations, etc. Rumors are widespread practices in the area of trading in stock of shares. Stakeholders usually spread rumors about a particular share to artificially make the share prices go up or down. Naturally, the victims of these rumors are the ordinary investors who, without validating the information, either tries to sell or buy the shares, resulting in loss for them. Secondly, the emotions and personal qualities also play a significant role in influencing the share prices. Often it is seen that the effect of these are not much, but still it results in changes in the share prices. Now, the brokers. Brokers are expected to follow the rules and regulations and abide by the regulatory authorities, and thereby holding the ethics of the profession, such as caring for the customer's benefit and being transparent. To be honest and staying away from these rumors. But however, some of the brokers disregard such things mainly because they want to make quick profits. They will make the investors buy and sell frequently because their profits depends upon the commission they get from the brokerage. So more the trading transactions, their brokerage is more, thereby making their profits. All these practices have an impact on the movement of shares, thereby making the share prices little volatile. Now, the stock exchange speculations. Speculations are an integral part of the financial markets. Their impact vary from one market to another, from one investor to another, and from one environment to another. Lastly, let us look at the other secondary factors which influences or changes the share prices. First is the economic strength of the market and its peers. This results in the change in prices. The actions of the underwriters also influence the change in share prices. An underwriter is a person who guarantees the minimum amount of shares of a particular company. In case minimum subscription is not attained, the underwriter has to buy the shares himself, with a view of creating a good demand for the shares of the company underwritten by them. The underwriters start buying these shares through their agents. This may create an artificial demand in the market, thereby pushing the share prices up. Now, another reason is the buying behavior of institutional investors. Supposing if the institutional investors like IDBI, ICICI, LIC starts buying and investing in stock of a particular company, it also creates demand for these shares, thereby pushing the share prices up. Listing of a particular share in more than one market also fluctuates the price of the shares. If in one market, if the price goes down, it may eventually result in declining the price of a particular company shares in another market as well. Lastly, the market sentiments. Market sentiment refers to the psychology of the market participants individually and collectively. This is perhaps the most vexing category. Market sentiments are often subjective, biased, and obstinate. So, what are the key takeaways? Stock prices are driven by a variety of factors, but ultimately the price at any given point of time is due to the supply and demand factors at that particular point in the market. Fundamental factors drive stock prices based on companies' earnings and profitability from producing and selling goods and services. Technical factors relate to companies' price history in the market pertaining to chart patterns, momentum, and behavioral factors of traders and investors. Thank you for watching. If you like this video, please press the like button and share and subscribe. I'll be back with some more insights soon. Take care.